So yes, we saw somewhat of an undesirable close. We saw, some sort of second shoulder that wasn't as high, not giving us any sort of trend. And then an aggressive-ish, nothing crazy, sell-off that brought us from green to red in the S&P 500. It is what it is. I don't know what that means, but I don't think it's going to mean anything for too long. I think it might be some sort of panic sell right there at the end. But I'm not extrapolating that to the broader market. I'm looking at things like a coinciding stronger dollar index, just barely, with a coinciding slightly even stronger gold price, which is, as I said in yesterday's video, uncommon to see both of those move in the same direction. They technically shouldn't. Gold, hypothetically, has its intrinsic value and trades relative to dollars. And when there's, the demand for dollars goes up, demand for gold relative to those dollars should come down the amount the dollar goes up. But that's not happening. They're both going up at the same time, which tells me there's a fundamental concern or expectation around inflation. And we've talked about inflation. We expect inflation to be a lift all boats event. So I expect inflation to occur and lift all boats. We are seeing treasury yields somewhat stabilize a little bit, nothing crazy. Not a dramatic move today, a little bit of a pullback in the morning especially. So that might be a good thing. I don't really expect and believe the market should sell off on rising treasury yields. I know that is historically what happens, but as I'd like to say, I want to make a distinction between real and nominal rates. And in a high inflation environment, this distinction is very, very important. It historically, in the last 10, 20, 30 years, where people have seen this trend occur, where rising interest rates mean stocks fall off, in this historical period where that has been the trend and that cause and effect relationship has happened, there's been little to no inflation. But we are now in an environment where inflation is the reason treasury yields are ticking up. And if inflation occurs, stock prices in the long run should be lifted because inflation is a lift all boats event. So any sort of sell-off on rising bond yields, which is caused by rising inflation, should be taken as a buying opportunity ceteris paribus, meaning all else equal. If we're just getting a sell-off on inflation concerns because the bond market is bigger than the stock market, well, buy the stocks because that shouldn't be happening. If inflation is occurring, we should buy stocks. So today's, it's whatever day, it's Friday. But there is a bigger concern I have, and that's in the geopolitical space. I do not like the tensions that are going on between the United States and Russia and China. It's not like I'm super concerned about this all of a sudden. But it seems to me like they were behind the cyber attacks. They aren't happy with us. We aren't happy with them. Seems like they don't really respect Joe Biden, which is unfortunate, but not too surprising in my opinion, given that he fell off the staircase today. First public appearance since that meeting on a flight to Georgia, which is clearly a political stunt to take over the state, turn it blue, which hasn't been in so long since this last election. Anyways, something's brewing there. The rhetoric is a little too tough for me. It's a little too much. It's still very early, but it's definitely something to keep an eye on. That could lead to things. It's too early to say what those things would be, but inflation occurring is good for stocks. It's also good for the debt. China's going to get less money. But that's going to make China angry, and China is going to be angry. Something to worry about. Something to think about. We will see what happens. And until next time, peace out.